Hello and welcome everyone. Thanks for logging in and listening to this extremely relevant and timely podcast, which is going to provide you with an oversight of socially responsible and environmental, social, and governance investing, commonly called SRI and ESG. As we all know, this year, 2020, has been an extremely emotional, infuriating, and impactful year for our personal, professional, and financial lives. But what this year has also done, though, is raise the bar on pinpointing and aligning many people's ethics and values into their life. As a result, many people are interested, more so now, in aligning their investment objectives with their values. So we're extremely pleased and honored to have as our guest speaker today, Margaret Leon with Nuveen, one of the global leaders in responsible investing. She leads a team of specialists who covers ETFs, 529 plans, and TIAA wealth distributions. Welcome, Margaret. So tell us, there are not that many women in the financial industry. How did you get into this industry?
Thanks for having me, Renee. It's interesting. It wasn't the initial plan. I got my undergraduate degree at UC Irvine in psychology and social behavior. And I had this idea that I was going to work with families and our community and helping them reach their personal goals. And what I found was it was a little bit isolating for me. And I jumped into sales. It happened to be financial sales, where we get to engage with investors and help them reach their financial goals. So it actually really translated seamlessly.
Absolutely. And you are a social worker, and the psychology is helping too, because being in this industry, you definitely, you got to have that skill set. So wonderful. We need more of you. So we'll work on that. Anyway, so let's just get started. You know, we often hear and read these investment initials, RI, SRI, ESG. So can you explain what each of these initials mean and what their objectives are, and just give us a little bit of history about how all this started?
Sure, yeah, and it can feel a lot like alphabet soup. So I think to break it down easily, especially if you're doing your own research and Googling some of these terms, you might find yourself going in circles. I would think of it as responsible investing, RI, as an umbrella term that would encompass lots of different types of strategies. So under RI, you could have SRI, which stands for socially responsible investing. Historically, those types of investments would be ones that are concerned about our environmental impact specifically, or something like human rights or consumer protections to have good quality products that aren't poisoning us or something like that. So socially responsible. The newer term that's under this umbrella is ESG. That's what we're finding is basically the more broad, most things for most people type of investing. ESG stands for environmental, social, and governance. And to expand upon that a little bit more, what we do is we measure the environmental impact of a company, the social responsibility, and its corporate governance, how well that company is run from basically an ethical standpoint.
So it sounds like it's definitely much broader base than RI and SRI, and it encompasses a lot of detail when you're looking internally at these companies. That's interesting because it certainly has evolved. So when did responsible investing start?
Yeah, I would say it absolutely has evolved. I would say we could trace back the beginnings of responsible investing over 50 years ago. If we think about what was happening in the late 60s and early 70s, there was a lot of political unrest. There was a lot of social injustice too. So we had students protesting the Vietnam War, not just students, but the professors as well, concerned about how their retirements were invested. That's actually the very first type of investing that our company, our parent company, TIAA, was involved with. So we think about, okay, we had the Vietnam War going on, and then a few years later, it was concerns about divesting in South Africa. And I think something that's really interesting to consider is that maybe history doesn't exactly repeat itself, but we definitely see it rhyme. And I think if we take a look at those times and we take a look at 2020, we have a lot of the same concerns. But back in the 70s and 60s, this was when we just first started out. So it was more of an exclusionary process. I don't want to be invested in weapons or defense. I don't want to be invested in energy or fossil fuels. Maybe if we start fast forwarding into the 90s, when we're in the Gulf War. And so it was actually in the early 90s when responsible investing, or SRI as it was called at the time, became an investable strategy for investors. We saw that a lot of the pioneers in this space were religious affiliations or perhaps values based upon certain religions. It's interesting because it also was very exclusionary. We don't want this, we don't want that, because I feel like it's wrong. So from that point on, we have been getting better at capturing information, doing research to see actually how we can incorporate these non-financial criteria of a company to make better investment decisions. So we've really evolved out of an exclusionary, perhaps faith-based investment to one that's inclusionary, looking at, okay, these companies are doing the best versus their peers when we measure their environmental impact, social, and governance.
Yeah. And I'm sure you have an answer for this. There's been so many statements made over the years about the performance of being in socially responsible investments, that they underperform, the markets, and why should I put my money in there? Any thoughts or feedback about that?
Definitely. Yeah, that is a common misconception on what responsible investing will deliver, that it's like, okay, I have some extra money that I can afford not to get the full return of the market, and I'm just doing this to be nice. So once upon a time, that actually was the case because there wasn't an exact science behind it. There wasn't the investment rationale because it was just the chop, 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 let's get this dirty stuff out. Well, now the way that we're doing the research is that we're saying, okay, let's look at what we can identify as a key performance indicator. That when we have these types of components in a company, they actually outperform. And it's really interesting. I don't know if this is the right time to bring it up, but
yes, it is.
Okay. The majority of the value of our market, of the S&P 500, is in intangible assets. So what does that mean? It's not in product that's been made, that's going on a truck and getting shipped across the country. That's not the value of the company. The value in the company is the things that we can't actually put our fingers on. It's the intelligence of your employees. It's the satisfaction of your employees. Because right now we have this work from home situation. What if I was like, I'm frustrated, I gotta go. Yeah. Like, you could easily move on to another company. So it's employee satisfaction, brand recognition, brand reputation, huge right now. Everyone's got to take a stand. If you have two very similar companies, let's say you're a rideshare company, let's say it's Uber or Lyft, just for an example. If Uber is doing something bad and their CEO is saying bad things, and maybe there's a hashtag that's created, hashtag delete Uber, something like that, people are going to go towards Lyft. If Lyft is coming out with statements about how they feel about this racial inequality or hostile work environments or things like that. So it's in that reputation that we're finding value. And to take this full circle, it helps the performance of companies versus their peers. And so that's what we're really looking at. We're looking for companies that are forward thinking, that are progressive, that are doing the right things before they're forced to, and we find them outperform.
Interesting. That was an interesting point, though, about, employees' experience, and do you get that? You guys just watch social media to see if employees says, oh, this is a horrible place to work, and that helps to do some of the research in these companies. That's didn't even think about that before. Are you finding, though, that companies are finally beginning to see the importance of being an ESG player, and that they are trying to change their culture and environment to be aligned with that? Or are they still kind of stuck over here, and just maybe newer companies are saying, yeah, we need to be aligned with this, this concept?
I think it's across the board. And I think that even as just individual consumers, if I took off my professional investor hat and just looked at my iPhone every single morning when I open up my email, over the past 6 months, I think I've done 90% of my shopping online, whether it's grocery stores or buying a new TV or a mattress because I moved. And so everyone has my email address. And so my point is that I have been receiving an overwhelming response from companies, old and new, on their standpoint of what's going on, whether it's the violence in the street or political uncertainty. These companies, whether it's the millennial toothbrush that I use, Quip, or something that's old school like Target that's been around forever. And so companies big and small, new and old, are definitely taking a stand, whether they're just repeating what they've already been doing and letting consumers know their stance, or if they're making a shift. We're seeing it both ways, but either way, I think it's both positive and progressive, these forced changes.
Yeah, I would agree. And do you find that it's mostly that it is consumers that are saying, oh, we don't want to do business with you because you're an XYZ or person, or, you're not supportive of women, or you're not, hiring people of color? Because it seems like there's a lot more consumers that are jumping in and saying, we're not going to do business with you.
Yeah, absolutely. I don't have a statistic on it, but absolutely the power that we have on these social media platforms and the way that we're transferring information now, it's a whole new world out there for companies to navigate.
Yeah.
It brings us to something that is food for thought, is that we have risks today that we did not consider 6 months ago, 6 years ago, 60 years ago. But even, especially in the past 6 months, we have to think about things that are a risk. Yeah. I don't think companies needed to have a statement on diversity and inclusion. They didn't have to have that 6 months ago. Today, if they haven't, they're underwater, they're behind their peers. So again, it's really interesting to think of what's a risk today that didn't exist before this pandemic.
Yeah, that's good. That's good. We'll come back to that. So can you explain, is there, and you did review this, is there a big difference between SRI and ESG? And is there more dominance in investing in one versus the other?
I would say not a big difference. They're related. Let's call them cousins. So SRI is going to be maybe something more, again, that there is the actual social nature behind it. Maybe it's aligning with the UN Sustainable Development Goals, where people want to have a measurable impact with their investment. So that's going to be kind of a more refined version, I would say, of investing. And you might combine an ESG strategy with SRI. And so I'll explain what that means. In the beginning of our conversation, I said ESG is not an accolade, it's not an achievement. Basically, everyone gets an ESG score. It's like being a student in class. You could get an A, you could get an F. It's just your score. Okay. You have to know what to do with that information and where we draw the line of an ESG score. And so what we do in our investments that are ESG, we go ahead and say, okay, highest ESG scoring companies, but then we kind of have a social overlay even on that. So here's a great example. Investors feel like ESG should probably mean low carbon, like no dirty fuel, all of that. It doesn't. You could actually be an energy company, even a fossil fuel related company, and have a high ESG score. So what we do then is say, okay, well, the socially responsible ethos of this, we need to take another swipe and say, okay, on top of the ESG score, we're now going to reduce the carbon intensity by taking out all companies that have fossil fuel reserves. So they're related, but again, to rewind, ESG is just broader. Mm-hmm. And it's not really trying to solve for anything. It's just reporting out how companies are doing with their environmental impact, the social responsibility, and corporate governance.
Okay. Yeah, definitely much more broad-based, because I do see that there are some funds and some ETFs that say ESG, some that say SRI, And there's, some commonalities of the companies that are in either one. But you generally won't see anything that's in the energy space, for example, in ESG but this sounds like we are definitely, converting, and we're expanding and going up the ladder again with changing, I won't say changing, but expanding what our needs are from a socially responsible ESG perspective. We might be adding some additional requirements. I wonder, based on the fact that we've had this crazy year that we've had, is there going to be something added to what the requirements for being an ESG investment will be? Or is it pretty much as broad-based, there's nothing else really to add to that?
That's a great point, Renee. It's a constantly evolving space.
Mm-hmm.
And we're not doing this just so it's kind of like mea culpa. Not my fault if it doesn't work, but it's because we continue to get more information. And so if we are finding that there's a new key performance indicator that we hadn't considered before, but we know now that it's really important, sure, bring it in. So like, for example, something that I've been requested for over the past 4 months, it's really important to many investors, a common request that keeps coming in is they want to do business with businesses that are owned by people of color. This is something that I never had a request before May, and it's the most common request that I get now. And so whether it's just an emotional, social thing where like someone feels compelled to do this, I mean, we can unwind this and say like, well, what is the performance benefit of doing something like this? And is it important for results of a company to have, whether it's specific as a person of color, or if it's just ethnic diversity, which is likely a contributor to success, we'll definitely be open to incorporating those, especially as not to get too woo-woo here, but I think that 2020 is a year of an enhanced collective consciousness. People are starting to have a broader view of what's important, and they're starting to be concerned and voting with their dollars around that.
Yeah, I think that is a very good point to be able to add that as, a new level to focus on is, I'm just going to make up something, does Amazon support, and contract with companies that are owned by women and people of color, as an example? I'm sure Amazon does, but to start looking at that, to be able to say we need to be supportive of the community of people that we live in, as well as their businesses, and support them. And so I think that will be a great addition to the ESG piece. So we'll keep our eye and ears open for that one. So you mentioned this earlier. So what are some risks today that we're experiencing that we didn't experience before this pandemic?
Absolutely. I mean, we can just think about our day-to-day risks as being alive. So it's like, there's a risk to go to the grocery store that I didn't feel before, or, there's a risk to get on an airplane. We're not traveling for work. So, and that transcends just the personal risk into the business risks too. And I think one of like the most common business risks now that I think of that I wasn't so concerned about prior, I talk about online shopping, having food delivered, having, wax paper delivered, everything. What's important is, who am I giving my credit card information to? Data security, privacy. When you have a data breach of your client's information, whether it's Target, which happened a few years ago, which was not in our portfolios, or Equifax, which gave everyone a little startle in America, thinking perhaps their information had been stolen. That's super duper important. I mean, it's more, we've been considering data privacy, security, and our identities for a few years now, but I think even more so now as this e-commerce has really become integral to most people's lives in the past 6 months, that it's a risk. I'm not going to go buy something new from, cheapgroceries.com. I'm going to go to something that's reputable. Sure. So there's that risk. I've been doing all of my meetings since March virtually. So I have a business risk of my internet working? Can you hear me? Can you hear me now? Right? Like all of that. And then, I mean, when this first started, we heard about this whole new concept, Zoom bombing. Remember that? People were busting into Zoom meetings, getting confidential information, or just being rude. Never heard of Zoom bomb before March. So we need to up our security. We need to evolve with the way that we're doing business. And so it's really interesting to think about how companies are responding to these new needs. And it's definitely important for the longevity of them and for the consumers that use the products.
Yeah, that's a very good point. You know, the cybersecurity piece is extremely important because many people are working from home, and or if they're just at home, but they're not protecting their Wi-Fi or their network, they could get slammed. And, you know, folks have access to their content. And so that's another area for sure that it's probably going to just rise up, and it's going to be a major issue going forward. So this pandemic this year, I'd like to say that this year's just been a hot mess and it's nasty, and that hopefully we're getting all of the bad stuff in this year so that the rest of the decade will be cleaned up and better, that we are learning what to do and what not to do. So keep fingers crossed. So final two questions. Can you give us some examples of companies that fall into the categories of ESG and SRI?
Sure. So I mentioned Equifax as being negative. I'll just start with the bad and we'll end with this.
Okay.
So that's a common story that we tell for ESG that we identified, actually, if you could just look at an ESG score of a company before a catastrophic event. So like, let's get out before a catastrophic event. So this, sometimes I call it ESG my crystal ball. So what do I see? I see a lot of bad energy, you could say, around this company, and something's going to blow and I just don't know why. So in the case of Equifax, we saw really weak ESG criteria around a few things. One was they actually already had a smaller data breach of a few 100,000 names. And so as ESG researchers, we went in and said, hey, what are you doing about this security issue? And there was no answer. It was just business as usual. So that was poor corporate governance. Yeah, so that did not look too good. The other thing is, under corporate governance, we looked at CEO compensation, and Equifax CEO is getting 3 times industry comp. So it's like, be a CEO, make $1 jillion, that's fine. But if you're Equifax and then Experian and whatever that one
TransUnion,
TransUnion, if you're getting paid 3 times as much, I mean, is that in the best interest of your shareholder?
Wow.
And then the third thing where they were weak for ESG was that their board had very low gender diversity. And what we're saying now in 2020, it's not just a nice to have. We're not just letting the girls play because you have to. It's like what I mentioned in the beginning of our chat here, is that when you have different experiences, you can bring different solutions to the table when you have challenges. And so maybe if they had a few more women on that board, they could have said, hey, maybe we should look at this security issue that we have.
Yeah.
And then anyhow, so because of that, they were not investable from an ESG standpoint as far as our criteria was concerned. 9 months later, they have this massive data breach. Their stock price falls off a cliff. It looks like this, a big drop. And so that's an example of non-financials. It's just kind of the way that the company is run, that we thought, this is not a good company. It's not what you find on the balance sheet. It's these other things that we're measuring now. So Equifax is an example of a poor company. A strong ESG company, and this one's really controversial, so I'm glad I don't have a live audience to challenge me on this one, but I thought it would be fun to bring up. McDonald's actually oftentimes has a high ESG score.
They've just been in a hot mess here recently with our former CEO, but yes, go ahead.
Yeah, well, let me just, and we can give some other examples, but just, this is why I'm saying like ESG is a score and not an accolade. But yes, McDonald's is responsible for feeding 1% of the world's population every single day. So they have a very high responsibility. And so versus their peers, they have been making strides about sustainable palm oil farming. And one of the most fantastic things that I was in a face-to-face meeting with was that it's the same CEO as one of the meat substitutes. It's one of the fake meats that we're consuming nowadays. And they have a side business that was making sugar-free iced tea, not so 0 calories. And McDonald's brought this beverage on into their soda fountains. And because of that option to have, instead of a regular full sugared soda, they saved, it was like 30 million calories in 1 year just by having this option. And so I know it's controversial, but I just want to say, like, it's really interesting how we can say, how are we making an impact for what we have, like a best in class approach that could be very controversial. One that's less controversial, Salesforce. I like this one. Recently, they're a technology and software company up in the Bay Area that's basically a behemoth. They have changed the landscape of San Francisco quite literally. They have the biggest building in town. What they are doing is acquiring lots of other tech companies. One in particular was Tableau. I use both of these products in my business. What's important about acquiring a company when you are a tech company is that, again, it's your resources are the human capital that you're acquiring. It's not trucks of product. You want to make sure that you have that human capital intact. That's the important part. And so they did a really good job of maintaining their workforce in the acquisition of Tableau, and they continue to do so.
Wow. And of course, they've just been added to the Dow Jones Industrial Index. That's huge. Wonderful. All right. Wow. Thank you so much for all of this. Now, at Urban Wealth Management, we're very supportive of Nuveen and their ESG investments. So if you just want to highlight a few of the ones that you, that you want to talk about, then people can be made aware of that, because we do run SRI portfolios here, and we have Nuveen's investments in there.
Sure. I could talk about a couple. I mean, we have developed a really broad lineup, a broad menu of strategies. So you don't have to sacrifice asset allocation in order to access responsible investing or ESG. Historically, that was the case. Usually you would just eliminate so many parts of the market, you'd be left with a large cap growth fund of equities, so of stocks. With Nuveen, you can invest in large growth or large value. You could even get into small cap, emerging markets, international. You can do an impact bond where you actually can see the impact of the projects that the bonds that you're investing in are making. I really like that impact report. So you can do just about anything here at Nuveen, whether it's stocks or bonds. If you want to measure your impact, we've got it all. And I know, René, that you're familiar with it, so you can help people, guide people to what they need for their financial plan.
Absolutely, absolutely. One actual last question. Can you share with us, what are some websites? Obviously, we can go to Nuveen, we can see, what positions are in there, but are there some research sites that you could suggest if somebody's looking for individual stocks to go in to see, if they fall into the ESG or SRI formats, what's a good research spots for them to go to?
That's a great question. I don't know the actual web address, but if you Google this, it should come up. Okay. I would Google MSCI, so Mary Sierra MS Charlie Indigo. I did MSCI, and then ESG score. And they actually have a public website where you can type in the ticker of a company, and they are usually, most companies will be in there for their ESG score. MSCI does a fantastic job researching. They do a little bit of research off of this material public information reports that the companies put out, and then the other half of their research is just good old-fashioned detective work where they're interviewing people, looking through trash cans, scoping out the parking lot. So that they're giving us the ESG scores, and it's really kind of fun to say, well, why the heck is this company in my portfolio, and it will give you some reasons why they could be an ESG leader or perhaps an ESG laggard. But yeah, I'd Google MSCI ESG score. It's public.
That would be great too, because we are a consumer-led economy too. And so if we are going to, doing business with a store that has a very low ESG score, then we're like, okay, no, I'm not going to do business with them because they're not, they're not on the high end list. And so I think that's also going to be important, not only for our investments, but who are we giving our money to, who, as a consumer, and really being able to expand that. So, right. Well, absolutely. Thank you so much. This is fantastic. And I know that many, many people are so interested in really aligning, again, their values and their ethics with their money, whether they're investing or they're spending or they're doing business with other people or other businesses. We want to make sure that they are aligned with what our true values are too. So thank you so much for your time. I know you're extremely busy, and look forward to continuing to work with you. We want to have you back next year during our Smart Women Savvy Money podcast as well. So take care, stay safe, and we will talk to you next year.
Sounds good. Thanks, Renee. Goodbye.